Good afternoon, my name is Garcia, and today I will be talking about the company background of Xerox. Formerly known as a haloid photographic company, the company was founded in 1906 in Rochester, New York. Joseph C. Wilson, credited as the founder of Xerox, took over haloid from his father, and in 1946 signed an agreement to develop the company as a commercial product. For more than half a century, Xerox has been a leader in document technology and services, and currently has almost 150,000 employees worldwide. Xerox Corporation is a technology and services enterprise that helps businesses deploy smarter document management strategies and find better ways to work. It offers an array of innovative document solutions, services and systems designed for offices and production printing environments.
Hello, my name is Kieu, and today I'll be speaking about the accounting failure relating to Xerox. Xerox Corporation caused a controversy when the company conducted a fraud scheme from 1997 through to the year 2000 to defraud their investors and to meet the goals of Wall Street's expectations. Xerox applied accounting tactics such as accounting actions, one-offs, and accounting opportunities to disguise its potential operating performance from investors. From that, Xerox's recognition of equipment revenue increased dramatically, acquiring over $3 billion and increasing its pre-tax earning at estimated $1.5 billion. However, many of the accounting principles were in breach against the standards of GAAP and did not manage to disclose reports to investors of Xerox earning, which was viewed as a misrepresentation to its investors from Xerox's historical accounting practices.
Hi, I'm Singh. I'm going to talk about Xerox's failure with regards to corporate governance. Corporate governance, simply put, is the rules, systems, and processes that are used by companies to guide and control themselves. Now that we know that, why did Xerox fail? There are a number of reasons, but the main one I'm going to talk about is not obtaining an independent auditor. Picking the right auditor is a small but significant fragment of corporate governance. To me, this was the main failure for Xerox. If it had hired the right auditors that were independent, Xerox would never have gone through its accounting scandal. According to the US SEC, Xerox had an almost 40-year-long relationship with KPMG. In this time, Xerox had paid $26 million in auditing and $56 million in non-auditing fees to KPMG. KPMG's partners even advised in meetings within Xerox's auditing committee. I would go as far to say that KPMG faced all the threats to independence outlined in the Code of Ethics for Professional Accountants, such as self-interest, self-review, advocacy, familiarity, and I could even argue an intimidation threat based on the merits of this case. Essentially, a truly independent auditor would have caught the discrepancies immediately and provided an appropriate auditor's opinion, assurance, and report.
Hi, I'm Phillip and today I'll be speaking about the audit failure relating to Xerox. Audit failure is a process that occurs when an auditor wrongfully states that a report with false figures is actually correct. In the case of Xerox, KPMG was put under scrutiny when 4 of their employees were charged with actually doing this. They helped Xerox manipulate the figures over a 4-year period. It was found that KPMG assisted Xerox in the manipulation of its accounting practices to close a $3 billion gap between the actual results of the company and those reported to the general public in the annual reports. Also during this period, even though Xerox did not abide by accounting rules and regulations, KPMG continued to state that they were in fact actually free of any wrongdoing.
To conclude this presentation, we can state Xerox failed to live up to its name by portraying itself as a corporation who continuously meets or exceeds its competitors' earnings per quarter. Eventually, Xerox was fined $10 million by the SEC, consenting to entry for breach of fraud, whilst also agreeing to conduct a further audit into the company as a consequence.
With regards to corporate governance failure, Xerox could have done a lot more things, such as hired officers and directors that actually knew what was going on instead of being asleep at the wheel. They could also align management incentives, but most importantly, like I said earlier, they should have hired independent auditors.
As was previously stated, the SEC got involved and they had a case against KPMG. They actually also had a civil suit, which was then used to refund the stockholders who lost money during the fraudulent period. In the future, obviously KPMG and Xerox will be kept apart. There'll be tighter regulations on both to make sure that this doesn't happen again, and KPMG just won't be auditors of Xerox ever again.
Thank you.